Will the Chinese market continue to boom, or will it burst? Let's find out. A Chinese boom. Let's address China. And I have a few charts I want to share with you. What you're looking at, the blue line, is an ETF called the iShares China ETF, right? It's an ETF, exchange traded fund. And the yellow line is the S&P 500, just the S&P 500, index. You can see that year to date, and these are year to date returns, that China is up 18.57% through its ETF, the FXI, while the S&P is up 2.78%. Now, those types of returns are pretty darn good, anything, right? And this is China, and people get a little bit worried, they're not getting a little bit worried. They are worried. As China does a few things, monetary policy in China is kind of changing, and I'll explain to you a little bit more as to why and what they're doing. But let's take a closer look at the returns. This is back from April of 2014 to present. China, through that ETF, is up 37.44%, while the S&P 500 is 12.22%. So what the heck is going on with China? And is China going to burst? If you haven't heard those headlines, you will soon, right? China's done a few things. Let me explain to you what's happening to China. And I'm going to just focus on this chart for a second. Talk about that ETF, the FXI. The FXI is an ETF that it's not directly invested into Chinese stocks. You see, the problem has been for a long time that it's been hard for outside investors to invest in China because there was no real efficient way to do so. And so FXI was probably one of the easiest ways to go about it. And what that is it's Chinese companies traded on the Hong Kong exchange. Hong Kong directly, into China. So you have to go through Hong Kong to go to China. And so you'd buy these shares of stock of Chinese companies that are trading on the Hong Kong exchange to get, they're known as H shares, to get allocated towards China. If you want those types of returns, 37.44%, then you would have to invest through Hong Kong, right? Through what's called an ETF through ADR. And I'm not going to get into the complexities, but just know you're trading on a Hong Kong exchange. So the issue has been, for many, many years, how can investors invest directly in China, right? And that's where we're starting to see some changes. That's what's in large part causing this so-called bubble to form, is that for the first time, China is allowing outside money to flow into the country. And this is nothing, I think back in March we talked about this at great extent on this video, on this same type of video. But that's what's happening. And so you've got this potential bubble forming in China. And I'm going to pause there for a moment. So the question again being, is China going to burst? Is that bubble going to burst? And it's important for some of our clients who may have exposure to China. Okay? And for those that don't, this is not a recommendation that I'm going to share with you. Know the risks, know the volatility of emerging markets, but also recognize the reward as well. So let's talk about China in the World Index. And I want to introduce something to you. It's an organization called the MSCI. And the MSCI is a benchmarking company. Call it a benchmarking company. What I mean by that, and here's from their own website. I took this picture from their own website. A benchmark, just so that before we hit all those little graphics and things, a benchmark is something like the S&P 500. It's like the all-world country index, which we benchmark some of our clients to, right? It's something that you compare yourself to. And so the MSCI builds these benchmarks and has since the late 60s. And if you look at that chart from left to right, $9.5 trillion in assets are benchmarked to the MSCI indexes. Those indexes include emerging market indexes, global, the developed non-U.S. Indexes, global indexes, U.S.-based indexes, a lot of different indexes. 98 of a top 100 global investment managers are clients of the firm, right, of MSCI, and I hope this isn't coming across as a sales pitch. But 675 ETFs are built on the MSCI indexes. The All-World Country Index, which, again, a lot of our clients are benchmarked to, the ACWI is the ticker symbol, is benchmarked to one of the MSCI indexes, right? And so, very big company, and you can see there that 95% are of U.S. pension funds and assets are benchmarked to the MSCI. So, a big, huge firm that carries a lot of weight. Their decisions carry a ton of weight. And you'll understand what China has to do with this in a second. All right? When MSCI makes a change to any benchmark, it's a huge deal, as you can imagine, with $9.5 trillion in assets being benchmarked to what they do. Huge firm, huge decisions that they make and how they benchmark the different indexes. All right? So, what does that have to do with China? Let's take a look at this. This is just a little table. It tells you the stock market, the size in trillions of dollars, and percent of the world as far as the allocation in dollars, right? So here you have the United States, $24.8 trillion, and the percentage of the world is 34.7%. China, $8 trillion, 11.1%. It's the second biggest, call it market in the world. Japan, third, $5 trillion, 7%. United Kingdom on down the line to France. All right, so just pure size and scope, $8 trillion in China, the size of their stock market, 11.1% of the world, right? Here's the problem. Here is the MSCI World Index. This is how it's currently constructed. The United States makes up 50% of that index. And the ticker symbol for this, if you want to look it up on your own, would be ACWI. Japan is 7.8, United Kingdom 7.1, France 3.5, and then China comes in at 2.7. So currently China, which is the second biggest market in the world in terms of dollars, is the last, at least in this list of countries, making up 2.7% of an index where it should arguably be 11.1. So you can see the situation at hand. Here you got the second biggest market in the world that is not, as far as the MSCI concerned, it's not allocated that way in their benchmarks, right, in their indexes. And so here's what's happening right now. And the reason I bring this up on June 9th, which is just in 8 days from now, the MSCI is actually going to make a decision. Should we up the Chinese exposure in our indexes? That's the decision they're going to make. And they're going to weigh a lot of things. A lot of pros, a lot of cons. A lot of people will argue that no, the Chinese market maybe isn't there's not enough clarity. We don't know if the reports we're getting are real or not. Some people may argue, well, it's hard to invest in China, and that's probably the main argument. It's been hard to invest in Chinese companies. Well, as mentioned before, China's been making it easier and easier. They opened up what is it called? The Shanghai Hong Kong Connect, which allows people to invest directly into Chinese companies and buy local Chinese companies through the Chinese stock market. They're going to come out with later this year the Shenzhen, if I'm saying that right, Hong Kong Connect, which will make it even that much easier. So China has really been making a lot of decisions to allow people to invest more in their country, and that's what's, again, causing that bubble. Well, here's the thing. With all of this said, MSCI on June 9th, will be making the decision. Because of the strides that China has made, shall we now up the allocation of our indexes to appropriately account for China's true size, right? It's the second biggest market in the world, economy in the world. Should we change the allocation? If they do, look at the graphic up at the top. $9.5 trillion tied to these indexes. If they decide, you know what, let's take China from 2.7 to 7%, even 5%. If it's 11%, that'd be outrageous. But let's say 5%. If we double it and go 5%, then think about what all these asset managers around the globe are going to be forced to do. They will be forced to reconstruct ETFs, their benchmarks, investments, pension fund. All these people will have to adjust and will have to buy more Chinese shares to just to match a benchmark that MSCI creates. So huge decision. In fact, hundreds of billions of dollars are riding on this June 9th decision. So what do we expect at Iron Gate Global? I think our expectation is MSCI will, they're not political. They just make decisions based on the economy and the markets around them. So I think that they will be forced at some point to raise the allocation to China. They have to, right? Especially as China makes it easier and easier to invest in their country. They won't do it overnight. They won't come out on June 9th and say, yep, let's up it. Because that would cause such a mass, billions and billions of dollars overnight, that it would move markets, but it would be total chaos, causing the bubble to just go, the supposed bubble, just to go crazy, right? And so you'll probably see MSCI, you'll probably say, hear them make statements as to, okay, we've gone through the first step. China does, 2 or 3 other things, then we'll make the changes to the indexes or put criteria together that China has to meet just as a way to delay it. And so what you could potentially, if MSCI does do it and does begin the process, you'll see a ton of money move into China. Whereas the thought in the market right now is that China's in a bubble. Maybe it's not so much in a bubble, right? So that's the opportunity, and that's what you're going to be hearing about in the news. And that doesn't mean go out and buy China, but that means keep your eye on things if you're an educated investor and see what happens, see how this plays out. This is something that doesn't occur every day, certainly. Especially when you're talking hundreds of billions and billions plus dollars potentially at stake here. So watch that over the next month. Certainly we will. We'll be blogging about it on our website. And
this is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.